Ever wondered what a hedge fund is? Well, you're not alone. Hedge funds, in essence, are exclusive clubs for the investing elite, a sort of investment vehicle that pools capital from accredited individuals or institutional investors. These aren't your run-of-the-mill mutual funds or index funds. Nope, these are the high-stakes, high-reward playgrounds of the financial world. Hedge funds adopt a wide array of strategies, all aimed at one thing: earning active returns for their investors. That means they're not just trying to keep pace with the market, they're trying to beat it. They're the financial equivalent of a swing for the fences, a high-risk, high-reward approach to investing that can lead to big gains, but also big losses. So if you're intrigued by the prospect of playing in the big leagues of investing, stick around as we delve deeper into the world of hedge funds. Hedge funds have an interesting history. Let's take a quick look back. Our story begins in the year 1949 with a man named Alfred Winslow Jones. This former Fortune magazine writer turned financial genius is credited with creating the first hedge fund, a concept at that time as novel as it was strategic. Jones had a simple yet groundbreaking idea: to hedge the market by buying stocks while also short-selling others. This approach aimed to minimize the risk inherent in the market while maximizing the potential for profit. Jones's hedge fund model was met with incredible success, so much so that it sparked a new era in the world of finance. His fund's performance outpaced traditional mutual funds by a significant margin, and it wasn't long before others took notice. In the following decades, the hedge fund industry began to grow and evolve. More players entered the field, each bringing their own strategies and ideas. Some focused on arbitrage, others on distressed securities, and some even ventured into global macro strategies. The industry saw a boom in the 80s and 90s, with the number of hedge funds skyrocketing from a mere handful to thousands. But it wasn't all smooth sailing. The hedge fund industry has weathered its fair share of storms. The bursting of the dot-com bubble in the early 2000s and the financial crisis of 2008 posed significant challenges. Yet, these events also served as catalysts for change, leading to stricter regulations and more transparency. Despite these hurdles, hedge funds have continued to grow in size and influence. Today, they manage trillions of dollars in assets and play a pivotal role in global financial markets. Their strategies have become more sophisticated, and their reach has extended far beyond what Jones could have possibly imagined. In essence, the hedge fund industry has evolved from its humble beginnings into a complex, dynamic, and highly influential part of the financial landscape. It's a testament to the power of innovation and strategic risk-taking. So, that's how hedge funds were born and have grown into the financial giants they are today. Now, let's break down how these fascinating entities really work. Imagine hedge funds as a group of financial ninjas. They're agile, versatile, and unafraid to employ aggressive strategies to achieve their goals. One such strategy is leverage, which is essentially borrowing money to amplify potential returns. It's a high-risk, high-reward tactic. If a hedge fund's investments do well, the profits can be substantial. But if those investments falter, the losses can be significant too. Another tool in their arsenal is taking long positions. Here, hedge funds buy assets with the expectation that their price will rise over time. So, if a hedge fund manager sees potential in a particular company's stock, they might purchase shares, hoping to sell them later at a higher price. But what happens when the market isn't doing so well? That's where short positions come into play. In this strategy, a hedge fund borrows shares of a stock they believe will decrease in value. They sell these borrowed shares at the current price, and if their prediction is correct, they buy them back at a lower price, return the borrowed shares, and pocket the difference. Hedge funds also use derivative positions, such as futures and options, to hedge against potential losses in other investments. These financial instruments derive their value from underlying assets like stocks, bonds, or commodities. The ultimate goal of all these strategies? To generate high returns regardless of whether the market is bullish or bearish. This doesn't mean they always succeed, as even the most sophisticated strategies can falter. But when they do succeed, the rewards can be substantial. These aggressive strategies, combined with their ability to capitalize on both rising and falling markets, set hedge funds apart from traditional investment vehicles. They're not for the faint-hearted, but for those who understand their workings and are willing to take on the associated risks. They offer a unique and potentially rewarding investment opportunity. Understanding how hedge funds work can demystify their role in the financial markets. So, who exactly can invest in these sophisticated investment vehicles? Well, it's not as simple as walking into your local bank and opening up a hedge fund account. Due to the complex and risky nature of these funds, regulations restrict them to what's known as accredited investors. But what does being an accredited investor entail? In the United States, to qualify as an accredited investor, an individual or a couple would have to earn an income exceeding $200,000 or $300,000 respectively for the last 2 years. Alternatively, they could have a net worth exceeding $1 million, excluding their primary residence. These stringent requirements ensure that only those with a substantial financial cushion can participate, reducing the potential for catastrophic losses. It's a way of making sure that investors can afford to take on the high risks associated with hedge funds. Hedge funds aren't for everyone, but for those who qualify, they can be a powerful investment tool. Like any investment, hedge funds come with their own set of risks and rewards. Let's delve into the rewards first. The potential for high returns is one of the primary attractions of hedge funds. These funds are managed by seasoned professionals who employ sophisticated strategies and financial instruments to generate profits in both rising and falling markets. This active management often results in returns that can significantly outpace traditional investments. Another potential reward is diversification. Hedge funds invest in a broad range of assets from stocks and bonds to commodities and derivatives. This variety can provide a cushion against market volatility, reducing the risk of heavy losses when a particular asset class underperforms. Now, on to the risks. Lack of liquidity is one of the major pitfalls associated with hedge funds. These funds often require investors to commit their money for a fixed period, known as the lockup period. During this time, investors cannot withdraw their funds, which can be problematic in case of a financial emergency. High fees are another downside. Hedge funds typically charge a management fee, which is a percentage of the total assets, and a performance fee, which is a percentage of the profits. These fees can be substantial and can eat into the overall returns. Lastly, the potential for significant losses cannot be overlooked. Despite the sophisticated strategies employed, hedge funds are not immune to market risks. If the fund's investments perform poorly, investors can lose a substantial portion, or even all, of their investment. To sum it up, the allure of high returns and diversification offered by hedge funds is undeniable. However, these come with risks, including lack of liquidity, high fees, and the potential for significant losses. It's a game of high stakes where the potential for large gains is matched by the risk of substantial losses. Knowing the risks and rewards can help potential investors make informed decisions about hedge funds. So now you have a better understanding of what a hedge fund is and how it operates. Hedge funds, as we've learned, are investment vehicles that pool capital from accredited individuals or institutional investors and invest in a variety of assets. They were born out of the desire to hedge against the volatility of the stock market and to capitalize on both up and down movements in any market. We've seen how hedge funds operate. Unlike mutual funds, they're not subject to some of the regulations that are designed to protect investors, which allows them more flexibility in their investment strategies. They employ a range of strategies from leveraging, short selling, to using complex derivatives and algorithmic trading, all with a single goal: to generate high returns. We've also addressed who can invest in these funds. Generally, it's limited to accredited investors, those with a high net worth or a high annual income. This is because of the inherent risks associated with these types of investments, which brings us to the next point. The risks and rewards of hedge funds are significant. On one hand, they have the potential to generate impressive returns, far outperforming traditional investment strategies. But on the other hand, they can lead to substantial losses. The use of leverage can amplify profits, but it can also magnify losses. And the lack of regulation increases the risk of fraud and mismanagement. Therefore, it is critical to thoroughly research and consider the risks before investing in hedge funds. In conclusion, understanding hedge funds is not about becoming an expert overnight. It's about gaining the knowledge to make informed decisions. It's about seeing the potential for high returns, but also recognizing the risks involved. It's about knowing that while hedge funds can offer significant rewards, they are not for everyone. Remember, with knowledge comes power, and understanding hedge funds can help you navigate the world of finance with more confidence.